Volatility in stock market option buying best indicator strategies. What is volatility in stock market? Volatility in the stock market refers to the degree of variation or fluctuation in the price of stocks over a certain period of time. It measures how quickly and unpredictably stock prices change. A stock or market with high volatility experiences sharp price swings, while low volatility indicates more stable, less frequent price changes. Volatility is often used as a measure of risk, as large price swings can lead to significant gains or losses for investors. It can be caused by factors such as economic data, company earnings, geopolitical events, or market sentiment. Volatility is often expressed through indicators like 1. Historical volatility, HV, measures past price movements to estimate how much a stock's price has fluctuated over a period. 2. Implied volatility, IV. Derived from the price of options, it reflects market expectations for future volatility. 3. VIX, Volatility Index. Often called the fear gauge, it measures the market's expectation of volatility over the coming 30 days based on S&P 500 options. 4. Standard deviation, a statistical measure that shows the dispersion of returns from the mean. TAGRI 5, beta, a measure of a stock's volatility compared to the broader market. High volatility can result from various factors such as economic reports, company earnings announcements, geopolitical events, or changes in investor sentiment. It is often associated with higher risk but also greater potential for profit or loss. High volatility typically indicates uncertainty or risk in the market, while low volatility suggests stability. How important volatility in option buying? Volatility plays a crucial role in option buying because it directly impacts the option's price or premium. Here's why volatility is important. 1. Option pricing and volatility, implied volatility. Higher volatility generally leads to higher option premiums. This is because options become more valuable when there is more uncertainty in the market, as the chance of larger price swings increases. Lower volatility results in lower option premiums, as there is less expectation of significant price movement. 2. Impact on strategy. Buying options in high volatility. When volatility is high, options are expensive, and even if the underlying asset moves in your favor, the price increase in your option may be limited due to volatility contraction, implied volatility dropping. This is often referred to as volatility crush, which can reduce potential gains after events like earnings reports. Buying options in low volatility. Purchasing options when volatility is low can offer cheaper entry points. If volatility increases afterward, the option premium can increase even without much movement in the underlying asset, potentially leading to profits from the rise in implied volatility alone. 3. Greeks and volatility, Vega. The Greek metric Vega measures the sensitivity of the options price to changes in volatility. A higher Vega means the options price is more sensitive to changes in volatility. If volatility increases, the value of both call and put options rises, and if volatility decreases, both tend to lose value. 4. Event-driven volatility. Major market events, earnings announcements, economic data releases tend to spike volatility. Option buyers often anticipate these events, buying options to capture the expected volatility spike and potential price movement. 5. Risk management. High volatility increases the risk of larger losses for option buyers. If you're wrong on direction, the loss can be significant due to the inflated premiums paid up front. Conclusion. In option buying, understanding volatility is essential. Ideally, options are best bought when volatility is expected to rise, and timing purchases during low volatility environments can offer better pricing. However, high volatility environments also provide opportunities but require careful risk management to avoid overpaying. Most usable volatility indicator in option buying. When it comes to option buying, volatility plays a significant role in pricing, and selecting the right volatility indicator can give you an edge. The most commonly used and useful volatility indicators for option buying include 1. Implied volatility, IV. What it does, implied volatility represents the market's forecast of a stock's potential movement and is directly derived from the prices of options. Why it's useful. In option buying, it's crucial to understand whether options are priced higher or lower than usual. When IV is high, options are typically more expensive, which may reduce your profit margin unless there's significant movement. Conversely, low IV might signal cheaper options, making it favorable if you anticipate a large move in the underlying asset. 2. Bollinger Bands. What it does. Bollinger Bands are constructed using a stock's moving average and standard deviation, offering a visual sense of how much the stock is deviating from its normal range. Why it's useful. Bollinger Bands help identify periods of high or low volatility. When the bands widen, it indicates increased volatility, which could provide potential opportunities for options buyers if they expect a strong price move. 3. Average True Range, ATR. What it does. ATR measures market volatility by looking at the range of price movements over a given time frame. Why it's useful. ATR helps options buyers understand how volatile a stock is. Higher ATR values indicate larger price movements, which can help determine whether an option strategy might succeed. It can also help with timing. Entering a trade when volatility is picking up can be beneficial in option buying. 4. CBOE Volatility Index, VIX. What it does. The VIX measures the market's expectations for volatility in the broader market, S&P 500, over the next 30 days. Why it's useful. While not specific to individual stocks, the VIX gives a broader sense of market sentiment. If you're buying options on major indices or stocks correlated with the broader market, a rising VIX could signal heightened volatility and greater potential for large price swings. 5. Historical Volatility, HV. What it does. Historical volatility looks at the past price action of a stock to determine how much it has fluctuated over a specific period. Why it's useful. Comparing historical volatility to implied volatility can provide insight into whether options are currently overpriced or underpriced. If implied volatility is significantly higher than historical volatility, options might be expensive, signaling caution for buyers. 6. Volatility Smile Skew. What it does. A volatility smile or skew reflects how implied volatility varies with different strike prices and expiration dates. Why it's useful. Understanding the skew can help option buyers choose strike prices more strategically. For example, if the volatility is higher for out-of-the-money options, this could affect the pricing and risk of buying such options. Key consideration for option buyers. High IV. Options are expensive. Consider if the potential movement justifies the price. Low IV. Options are cheaper, favorable if you expect a significant price movement. For consistent option buying success, combining these indicators with other technical and fundamental analysis will help you determine the most opportune moments for entering and exiting trades. There are more videos in playlist if you would like to deeper dive into any points. Please check it out.